Have you heard about Bumpy, the hippo? Bumpy, this newborn hippo, recently rescued by the Kenya Wildlife Service, and I mean, he's taking the world by storm. He's so cute.
Yeah, I love him. It's like the next Moodang.
That's right. You know what else is bumpy? Have you seen the treasury markets today? Yikes. I read a Bloomberg article this morning that said that swaps are pricing in 2 rate increases in the UK. That's up from 2 rate decreases this year. Experts seem to think this is from the bond market fallout or as a reaction to inflation numbers.
Yeah. And that's interesting that it's in the UK too. I mean, the US, we have our own discussion. I'm sure Kevin Warsh has got his work cut out for him.
That's for sure.
And they always say that, no matter what it is, they've always got his work cut out for them. But yeah, that's interesting. It's happening not just in the US, it's happening in the UK. And I'm sure that there are other places, maybe Japan and other bond markets are troubled. And this is a global thing, which that to me suggests like it's just going to be harder to wriggle out of.
Yeah.
But let's talk about hippos again. And here's what I wrote here is that hippos are a lot like prices. They're real cute when they're small, but you don't want to go anywhere near them when you grow up.
That's true.
Yeah, you said that your son just shared earlier today that hippos kill more people than sharks.
Yes.
And yeah, I'd believe it, especially the big ones.
Yeah, that's right.
That being said, we'll see what leads up to this and the data that we have that shows that maybe we have an adult full-grown hippo here and not a cute little thing if we're talking about the inflation metaphor.
Mm-hmm.
The latest data from the CPI and PPI shows inflation increasing as expected, with a surprising jump in housing prices that we'll get to just in a moment. For several years, wage growth has outpaced rent growth, which has made rents increasingly more affordable. But recent numbers on declining apartment construction point to rent growth increasing maybe and returning to the pre-pandemic historical average of kind of increasing rent growth. Additionally, new analysis on homeownership and rent costs suggests that even though single-family home price growth has been slowing down, apartment rents may have more room to grow. And finally, a recent group of reports on CRE capital markets point to some diverging performance trends in the future and pent-up demand among investors. But first, let's get to the inflation numbers. I'm excited. I know you are, Dan. I just loved every part of this, but not as much as the hippo. So let's just cut to these numbers on inflation. The headline all items number for inflation, it is up from 3.3% in March. Now it is 3.8%, which is the highest it has been since May of 2023.
Whoa.
Here we go. Wow.
And the last time this was happening, those rates were coming down, not going up, right?
And that's, which is not a good thing.
No.
The trend is actually the scary part.
Yeah.
It is, we're not headed, the jump in last month was a little bit weaker than the jump the month before, but still it is this trajectory that is worrying people, because on a monthly basis, all items inflation went up 0.6% in April. And that's actually, again, a little less than the 0.9% in March, still quite high. I compounded the math in my head. I can't really do that compound math, but I can multiply by 12. And if inflation continues at the same rate, we've got 7% inflation, over 7%. Not great. Yeah. So not really good. And we say, okay, all items, that's just gas prices, and gas prices aren't going to go right back down, right? I still think I can't discount gas prices because I go to work every day and I fill up my car with gas. But let's just take them out of the situation right now. So core CPI takes away those volatile gas and the food and energy prices.
Mm-hmm.
And core CPI, actually, the annual number went from 2.6 to 2.8. So there's the jump here, 2.6 to 2.8. Again, an increase. Still relatively close to historical averages. So that's okay, better. It's a little bit on the higher side. It's still above the magical number of 2% that the Fed has previously set as their target.
Mm-hmm.
The monthly increase for core CPI was 0.4% in April, and that's up from 0.2% in March. Would have close to 5% core inflation if prices keep increasing at that same 0.4% rate for a full year. So not great again. I was surprised, and I noted this earlier in the intro, to see that shelter inflation had increased so much in the past month. I was like, what? I was flabbergasted. And then I read a little quick article on Zillow that explained everything. Basically, what they say, and the quote is, the April 2026 print is expected to show it's mechanical anomalies from the delayed inclusion of rent growth that was omitted from the October 2025 report due to the government shutdown.
Oh,
so
yeah.
6 months ago, or
Forgot about that.
Yeah, I know. Gosh, we have got other things to worry about.
Time
now.
flies.
Hey, can we think about the Hippo again? Oh.
Yeah.
I'm going to come back to that like 5 times today. But so there was that shutdown, and because of the way that the data is gathering, it is now catching up to those shutdown months, which means that the actual shelter inflation is skewed upwards significantly, which is good because we have been for a long time tracking lower shelter inflation costs. And here, let's just bring up the fun graph here. So if we look at, where's the shelter here? And so it had been declining until now it just jumps up. And so that's where I think that I think there's still room for it to decline a little bit more, but we are about at the same rate of shelter inflation now than we were pre-pandemic. So maybe we're just going to bump along like this. However, there is a case to be made where like we actually have to have that reversion to the mean dip below for a little bit.
Yeah, to get to the mean. Yeah.
To get to the mean. Otherwise, what are we doing this for? But also we also have these wonderful private data sources on apartment rents that have shown like negative rent growth. And I'm always wondering, when's that going to show up in the CPI? If you listen to previous episodes of the Multifamily Dispatch, you may learn that it may not ever show up because there is just a complete disconnection between private source apartment data and in the public source from the CPI. And in that episode, it was actually fun to discover how it used to be like a delay between rent growth and the rent growth from the private sources, like apartment lists, and then rent growth from public sources. Then that delay elongated. So it used to be like maybe 12 months or like 18 months. And then it was like 24 months. And now it's like 30 months and counting.
Which makes it irrelevant.
Yeah, it's irrelevant. So I don't even know what's happening there. I think that they gotta sharpen their pencils and get, and like, you know what? CoStar has that Cessna plane. Maybe the government can borrow it. Maybe we get a little bit more.
Don't they have their own plane?
Yeah, they could have
maybe a few.
Yeah, some like U-2 bombers or whatever, or like U-2 spy planes.
Surely they know. Yeah.
Great. Awesome. The government will solve everything. And I'm very confident in that. But okay, so back to Zillow. Zillow wrote that comment actually a few days before the CPI came out, and they updated the article to mention that these housing numbers actually came in a little bit higher than expected, but they still think that housing is going to have a deflationary impact on prices this year as the year progresses due to lower home price and rent growth. I, on the other hand, and we'll say this later, I see a little more room for higher rent growth, but we'll get to that later in the podcast. The rest of the CPI report is much more straightforward, if not like disappointing. Fuel oil's monthly increase was 5.8% in April, which is really high.
Yeah. But
still much lower than the enormous 30% jump. Again, 5.8%, extend that, times that by 12, and you're getting not a great number.
Not good. Yeah.
And so it's unsustainable that things can go up this much. But that's, again, it jumped 30% in March, and then 5.8% in April. A lot that's compounding. Annually, fuel oil is up 54%. So there's your annual number. Gas specifically was up 5.4% in April, and it went up after going up 21.2% in March. And for the year, gas is up 28.4% total. I mentioned fuel oil and gases. I kind of broke them out. Gases are included in the fuel oil bucket. Fuel oil has inflated more, and that's an important part of like inflation, because what is not included in gas is diesel, and that's going to fuel the tankers and the trucks that ship things all over the country, and that's going to really spread out the inflation. So
yeah, that's a great point.
And like there's just so many other things about this. I don't think it can be contained in energy prices, and that's why I get a little bit frustrated when people take the core and it is meant to fix volatility, but if you have gas prices up for a long period of time, then maybe it becomes increasingly relevant to keep tracking those things. And so that's why I'm always like shy to drop that and be like, well, let's just look at core. Let's just look at the one thing that did lower, which is actually, that's a really good point. I'm going to do a pivot here. And let's look at the bright side of things and see something that has, this is flying by the seat of my pants. I'm just looking for some great, a sunny spot for lower prices. Well, guess what? College textbooks are down 3%.
Recreational reading materials.
Recreational books, that's down to negative 2.9%. Dan, you did spot a really great point here. Admission to sporting events is down 3.4%, and the previous month it went down 10%. So great. So go to the baseball game, go to your football game, go to your basketball game. Forget all about gas. Take a bike there, though. You're not going to be able to afford it.
Go to the Indy 500.
Yeah. It's going to be cheaper.
Yeah.
That's awesome. Okay, great. One thing to note, though, and again, included in the all items number that I was just talking about is food prices. And it's not just tomato prices that are increasing. Meat prices, beef prices are up. Food overall is only up 3.2% yearly, which is below that CPI all items average of 3.8%. But the talk about fertilizer shortages and the downstream effects of things like high diesel costs is makes these food prices worth watching as an inflation driver in the months to come. And for that, I mentioned fertilizer. For that, we can turn to the PPI, which is the producer price index. And it's kind of a little bit of a leading indicator because it shows what the companies are getting these wholesale prices. And PPI shows these fertilizer prices increasing. Nitrogenates are up 4.2% in 1 month, which is a lot. And they're up 32.6% annually. Phosphates are up 8.5% last month and 14.3% annually. That's a lot. And I'm kind of spinning out here. I'm wondering what it does. What does this mean for investors?
I think maybe it means smaller fruits and vegetables, Matt.
Actually, I think you might have a point there. And maybe if it were just fertilizer prices, tiny produce would be the biggest impact here. But the PPI as a whole jumped 1.4% in a single month. And it's up 6% since last year, which is the biggest increase since December 2022. So that was even further into the inflation era with December 22, way more than the May 2023 of CPI. So we've got that CPI trending up. And if these PPI prices are a leading indicator for prices, they get passed on to the consumer, we could be dealing with longer and more sustained inflation. So again, what does that mean for investors? I think it means high interest rates.
That's
because,
right.
Yeah, okay, good. Inflation makes interest rates stay elevated because there is an anticipatory effect of maybe inflation making the Federal Reserve raise the federal funds rate.
And that's exactly what we're seeing in the bond market today.
Yeah, the thing in the UK. Yeah, people are thinking, oh, wait, this is what I am anticipating. I better, I better get ready for that.
Yep.
So if from the moment that the Fed started increasing interest rates, there were people expecting rates to come down. So this is kind of pulling back to the investor market. For the past 3 years, there was, I would say, in retrospect, it looks like a delusion. The minute rates struck, it would be any day. And maybe we're the people that were stuck on the wrong end of a bridge loan. But there were so many people expecting rates to come down. And when years passed and rates didn't come down like people expecting, that hope for interest rate relief, it never really left. Yeah. And they say it's hard for the gas prices will go up like a rocket and fall like a feather. I think that expectations and hopes are the same way. It has taken them very long for their high hopes to fall.
Been waiting 4 years.
Yeah, we've been waiting. Seriously, I think that this 2% inflation target is unrealistic, but now the best we can hope for is transitory inflation. And the last time the Fed talked about transitory inflation, well, one thing led to the other, and now we're still dealing with high interest rates.
I think they'll use a different word next time.
Yeah, temporary. Some synonyms. They're pulling up the thesaurus. Yeah. But I agree. And again, it's like the Fed does have their work cut out for them because we are entering in an inflationary period during a period where the Fed themselves has said that the current rates are restrictive. So now it could be even more restrictive, which is kind of a bummer.
And the hardest part about this, Matt, is that, interest rate policy doesn't impact the supply side.
Yeah.
It impacts the demand side.
Yeah.
And so what we're dealing with right now are supply side shocks to
Yeah.
oil and everything else that oil, is in, right? And so raising interest rates is not going to change the amount of supply that's available.
Yep.
So who knows?
I know, and that's a little bit of this frustrating thing is because it should be transitory. We know what is the cause, and we can see and imagine an end to it. And it's not like it seems far more limited than a global pandemic.
Mhm.
But again, this is what we're working with, and the longer it lasts, the more people are thinking, oh, okay, this is in for the long haul. I
Mhm.
will say, with this in mind, I think this is going to be a really interesting moment for the multifamily investment market, especially considering the kind of hopes that people used to have for lower rates. And after 3 years, I think some of those hopes did come down.
Mhm.
People started getting real and making, a practical decisions. I think that I think the cash flow will become increasingly more important, and with potential opportunities that could emerge in a market where sellers can no longer count on lower interest rates and an unrealistically low exit cap rate. So they may have to sell their properties for a lower price than they thought they would, because they were hanging on and extending their loans. And now you have this market that is based, hopefully, and I think increasingly so, on lower interest rates. On realistic expectations
Mhm.
rather than baseless hopes. But I will say, in terms of the cash flow, rising costs for renters that are outside of rent, that could lower renter demand. So there's going to be challenges. It's not like you can just scoop up things on the cheap and deal with it later. No, this is a market where that will still continue to reward people that know how to survive and know how to operate kind of in a lean situation.
Mhm.
So yes, the folks looking for low rates to save them, maybe those multifamily borrowers who have run out of extensions with loan maturity coming up, maybe that means that investors could see opportunities to buy apartment properties at lower prices. Um, but and I think that's something that Yardi Matrix has noted in their last week we reported on that, and actually Yardi Matrix reported on that, and I think a lot of people are looking for that. Is maybe we'll find some deals here, but we're still dealing with a situation where supply is making things difficult. And that's a question for you. What about elsewhere in this multifamily market and the supply trends that have dominated discussions of the investment market for the past years?
Yeah. So, supply and interest rate challenges, demographic challenges, all of these things have kind of pooled together to make things very difficult on developers for sure, and especially regionally. And so we have a couple of articles here, one from Marcus and Millichap and one from CoStar, that both show sizable declines in the construction starts for Q1 2026. So according to CoStar, apartment starts declined to about 55,000 nationally in Q1 of 26, which is the lowest quarterly level since 2011.
Wow.
Yeah, and it's about time. You can't
Yeah.
sustain that type of progress for
Yeah.
15 years,
Yeah.
and expect some sort of not expect some sort of reversion to the mean.
Mhm.
So that's just that we developed a lot of apartments over
Yep.
the last 15 years. In fact, since 2021, developers have added 2.1 million apartment units, which has expanded the national stock of multifamily housing by 11.2% just in the last 5 years. Nationally.
Wow.
Yeah. So if you drill in deeper here, about half of that construction occurred in Sunbelt metros. So increasing their inventory by almost 18% compared to 7.8% in all other markets.
Wow.
So
It's interesting. I have the numbers here pulled up for the supply, and in it's ranked its supply elevated in select markets. It says Miami, Charlotte, Tampa, Nashville, Austin, Columbus, Raleigh, Richmond. Really, only one of those, it's Columbus, ranks is in the Midwest, and the rest are firmly in the Sun Belt.
Yeah, absolutely. So it's baseball season. So I'm going to trot out my favorite line here, Matt. If you build it, they will come.
Yeah.
Well, developers have seen that they are coming, but in drips and drabs, and rather than in hordes to this new supply. So this weaker rent growth paired with higher financing costs, higher construction costs, lower demographic growth puts a big stop sign up for developers that are interested in building for profit. The construction activity, however, as we just talked about, it's not evenly distributed, and most of this activity remains in the south and mountain regions.
Yeah.
So, the 55,000 units that were started are still in these higher supply markets. So, but everything here in the good old Midwest is good, right? Supply has some pockets, but not too bad.
And that, again, I'm going to reiterate this narrative that I mentioned in an earlier episode of the Multifamily Dispatch, which is kind of like the "don't count out the South" narrative, and one that anticipates desperately, it seems like, an improvement and a balance of the supply and demand dynamics in the South. And I thought maybe there was something to the idea that, yes, the supply spiked really high in the South, the highest, and maybe it will be the first to crash down. But I don't think so. I think that the supply is going to remain elevated the longest in the highest supply markets, only because it just makes sense. Yes, you said that you can build it, they will come, but sometimes they don't come. And I said this earlier, it's like, you can't really build yes, I know, like the process of procreation, but it's harder to convince someone. And think about it, like I can build a building, but to convince someone to go over there, that's a whole nother animal. And you're depending on a vast web of economic, job, and population growth factors that, it's a lot easier to see, okay, they're building X amount of apartments and it's a lot harder to say, okay, yeah, X amount of people are going to come in here next year. And the fact of the matter is, these places have built a lot more apartments than people have moved into those. And you see it everywhere. I've been looking at population growth information. There was just a recent census report that talked about, actually one of the upshots of the report was that mid-sized cities are benefiting and large cities aren't. And all those mid-sized cities are in the South. They're growing a lot. But the fact is, the apartment supply just grew faster. That's the thing that you have to kind of keep in mind here. And it's true. Yeah, it's true in the South, and I guess in maybe select Midwestern markets, but really it is a tale of the South and like in the Mountain West, where they just built more.
Yeah, absolutely. And I think, if you take a different tact toward immigration policy, things change quickly.
Yeah, that's a really good point too. I mean, that was, some of those numbers went from like multiple millions to now it's like 350,000 for immigration. That was in that same report. Just really crazy.
Yeah. Yeah. So, overall the Midwest is balanced. So what can lift the spirits of multifamily developers and investors? Well, according to Marcus and Millichap, who always finds that silver lining,
I love them for it.
Aren't they great? Long-term demand drivers remain intact. They cite that over the past 15 years, the median age of first-time home buyers has increased from 30 years old to 40 years old.
Yeah.
Which delays the transition from renting to owning by obviously 10 years on average, right? So only about 31% of U.S. households, according to this report, have sufficient income to qualify for a loan to purchase a house. Median priced home right now. That's probably because interest rates went up so fast and have continued to stay elevated. So I'd be really interested to see like what percentage of U.S. households had sufficient income to qualify for a median priced home in other times of higher relative interest rates, right? So like, how many people made enough money to buy a home in the 70s and 80s?
Yeah.
Or how about leading up to the great financial crisis?
Yeah.
I find that statistic very interesting, but what it means for multifamily investors and apartment developers is that the renter cohort has grown substantially due to these high interest rates, which should generate positive demand for multifamily housing.
Yeah. Unfortunately, I don't have that data for how much money was used to buy a home in the 70s or 80s. probably be pretty easy to pick up, but I just didn't do it. But I do have a window into home ownership prices and rent growth for more recent years. And it really flows right into these articles from Apartment List, and there's a home price article from Cotality that talks about how homeownership costs now exceed renter costs by $1,000 a month. Now this is your average home price and your average rent price, and I will say that I think that it is a little bit of an apples to oranges comparison if you're comparing rents to home ownership costs. But I do think that in the minds of renters and home buyers, if you're looking to rent a house or to rent an apartment or a house or to buy a home, you're thinking about mortgage costs. Like, what's your monthly mortgage payment versus your monthly rent payment? I don't even think that people are thinking that far into the long-term maintenance. Maybe they are, but they're really thinking the most visible comparison is your mortgage and your monthly rent. And that really explains how you see how once interest rates really started to increase, then your home ownership costs really increased. It is a story of the increasing interest rates a little bit more than the increasing home prices. However, as you can see from another article that was issued just right after the other one from Apartment List, the home price changes have accelerated significantly compared to apartment rents too. But I want to cut to the chase though, as quick as I can here, and I know I had that preamble, but home buying prices used to be growing at impossible speeds, but those speeds are slowing down, and home renting prices have been slow for a long time, and they are set to speed up. That's the underlying expectation that I have, and it's not necessarily, you may not be able to find it perfectly with this information on these graphs because you see the length of time that it has taken for this stagnation in rent prices. But there is a case to be made that there is room to grow in the apartment market, and it's precisely because of those supply cliff is now we're kind of falling off it a little bit, and there's a slowdown in that apartment supply should really make rents come into more balance, maybe rent growth a little bit stronger. But if you're in the single family home market, well, no, the home prices are probably set to decline. And I think that is a combined effect of just the years of consistent home price growth. And now it's just more than the market can bear. Cotality has measured only 0.4% annual home price growth. And it has been continually tracking slowing home price growth. Not negative yet, but it could be negative very soon. And this is, again, a far cry from the 5% home price growth that we had from 2014 to 2020. And that's pre-pandemic. And considering that home price growth peaked so insanely high post-pandemic, I do think, again, nationwide, that home prices will go from slowly growing to slowly falling. And you can see I should have pulled this up earlier, but the real fall off in home price growth happened between June 2022 to January 2023. And that was, I think, partly a reaction to the initial interest rate hikes. But then inexorably went up from there, and now we may see it come back down again just because, again, the market just can't bear it. Look, I didn't ask to live in these interesting times, but here we are. I don't think that apartment rents are going to follow the same path as slowing home prices. But if you'd like to sit down for a long story, I could weave you a tale about interest rates, exuberant home builders, irrational home buyers, and a renter population that has benefited from improving affordability for several years running. It could be a wash if completely if you draw a straight line, but if anything, for the past few years, the discussion hasn't been, oh, rents are so high. It's been rents are increasingly affordable. And as these Apartment List charts illustrate, home price growth has outpaced rent growth so very much. The big divergence happened in the early months of 2023. Rent growth over these 3 years was actually negative, a little bit negative, but essentially negative. Home price growth was positive, I would say irrationally exuberant, and maybe that's why we're getting the correction now. People built those buildings, and we know what happened. They built so much, and then in 2023 and 2024, 25, after the buildings were completed, well, we got the supply bump we're still dealing with. But now apartment construction has slowed. Lower supply growth and consistent demand growth means that apartment rent prices should trend higher. But home prices, not so much. I think we're in this rare situation where home price growth will get lower and lower, rent growth will get higher and higher, and it is only because of the apartment buildings that the builders built a lot of the buildings that they built. So yes.
It sounded a little like Dr. Seuss.
I know. I really
It's
wanted
great.
to say that too. And this is also because of high interest rates that discourage these elevated home prices, and arguably because of general other inflation pressures that are making it, just more difficult for people to afford.
Mhm.
So yes, there's a whole basket of issues and things to get worried about, but I don't think that rent is one of them at the moment for people, and it is only because of those building pressures.
Hmm.
Yes.
So, how to transition here? How about from Main Street to Wall Street?
All right, I left you with that.
Maybe a little too predictable. How about
That's
this one?
great. I think it works fine, just perfectly.
Thanks, Matt. Now we're going to talk about capital markets.
I love that transition.
Anyway, so we saw 3 good articles come out this week touching on the health of the capital markets. That is, buyers, sellers, and the debt markets.
Okay.
We heard from Newmark and Colliers about how Q1 measured up, and Moody's Analytics has a ton of graphs to dig into with their predictions for the future. So just quickly distilling down the Newmark and the Colliers articles, they both noted that transaction volume increased year over year. We felt that. And predictably, debt origination also increased year over year, which makes sense.
Mm-hmm.
However, cap rates remain largely stable, which is probably driven by the lower capital supply of private equity dry powder. So they also note that, the amount of dry powder for private equity has declined 2.6% year over year and is down 13% since its peak in December of 2022.
Why?
Well, they note that buyers and sellers are increasingly finding this common ground, and the bid-ask spread has narrowed. But up until now, it's been people just saying like, "Oh gosh, I don't know. I need to take some chips off the table."
Yeah.
You go from this high water mark in December of 2022 where all of these groups needed access to capital. And access to real estate and allocation to now, oh boy, this is kind of scary. Right?
Okay, I really like that point. And I should have put this opening in the notes here because for years people were bragging about the amount of dry powder out there as like, yeah, that means that people are going to invest. I think the dry powder is a result of people not investing. But so the fact that there's lower dry powder just means that, actually people are participating in the market. And so it's a little bit of the inversion of the common trope that I've been seeing a lot of, like, yeah, let's brag about this. Well, that's not really a good sign. They're waiting. And like, this is what I said for the past 4 years, like, we're waiting for this knight in shining armor that is not going to come.
It's not
But
showing
it looks
up.
like now they're realizing, okay, this guy's got his armor's not so shiny, but by golly, he's great. I'm going to take him home and marry him.
Well, I think you're exactly right. You look at the amount of dry powder. It's not the amount of dollars allocated to real estate investment, right?
Yeah.
That would be a different story. But this is the amount of dry powder. So in my mind, that's capital that has been allocated to real estate but not invested in real estate, right?
Yes.
So I think that they kind of go hand in hand in that the bid-ask spread, what buyers are willing to pay versus what sellers are willing to sell for, is closing, which means there's activity in the market. Right?
I kind of alluded to this, and maybe I'm beating a dead horse a little bit. But like, we were waiting for all these years for something to happen to get people to realize this is the world we're living in. We can't wait for rates to go down or something like that. Or people just thinking like, no, things are going to pick up a lot more and justify this sinking ship that I'm on. And now maybe this current environment where transitory is turning into sustained, it could be this like really shock that has gotten people to realize, all right, let's actually do something that's realistic instead of relying on vague hopes.
Yeah, and I think we've talked about this in past multifamily dispatch podcasts, and that is that 2026 is, we think, the year where all this stuff gets sorted out, right?
Yeah.
The distress has to go through the system. 2027 will be nice, but
How many rhymes do we have? How many rhymes? Everyone knows if you're a CRE investor, it was survive until 25, and
That's
then it
right.
was pick up your sticks in 26, and then it was like, is it going to be 2007 or is it going to be 2011? I don't know.
I don't know.
There were all these rhyming things, and I just kept thinking, if you have to rely on that, and
It's
guess
not a
what?
strategy.
Yeah, it wasn't a strategy, and it didn't work.
That's
People,
right.
I think we're saying maybe that was part. That's now we look back at it, and that was a symptom of the real root cause, which is like kind of a delusion that things would get better really quickly. And I do still think that the minute rates went high, people thought they would go back down. You could probably find like the Fed futures and see how like, oh yeah, they think it's going to go down. They think it's going to go down. And it never did.
And it just hasn't. Yeah, it just has not. So, if we, that's a great segue actually to the Moody's Analytics Consumer Sentiment
Got it
Index.
pulled up right here.
So yeah, I mean, you look at this, and right now we are at the lowest consumer sentiment, according to the University of Michigan's Consumer Sentiment Index, than ever before. In like, this thing goes back almost 75 years. We're lower than COVID. We're lower than the Great Financial Crisis. We're lower than the stagflation period of the 70s.
Yeah.
And then somehow Moody's Analytics is predicting we just snap back up to the mean at the end of 26, 27. What did they know that we don't know, Matt?
I know. There's got to be something fantastic that happens, and maybe it is, but I don't know. I think there's something wrong with their model.
I don't know either. I want to believe this. I think the forecast looks amazing, and I hope that we get there in 27. But
I will put as a caveat, the conference board has a more realistic take, or at least it shows that consumer sentiment is lower, but it's not like the lowest ever. And so I think it's a little bit more easier to understand there.
I think so too. The other graph that I want to touch on here with regard to this Moody's report is it's titled "The Great Divergence: Oversupplied A versus Tight B/C Markets." So the graph on the left shows vacancy rates have been trending up in both A and B C subsets. So Class A apartments are in blue. Class B C apartments are in green here. You can see kind of a drastic increase in blue and a slower increase in green.
Yeah.
I think that, B and C is kind of mostly leveled out. These are renters by necessity, not by choice, primarily. And, I think that perhaps these Class A properties are actually dragging the BC properties vacancy up, just in greater concessions and closing the gap between the cost of an A and a B.
The trickle down kind
Right.
of. Yeah, I think that's a good point. I wonder. I think that I think it's a temporal thing. Like maybe A's are vacant for a little while and then B's get vacant or something. I think it probably varies in that way. I do think that this consistent increase is probably because new supply is always Class A, or usually is.
Yeah, that's right.
That's why, and that's why it's been up so much. I do wonder too, though, you were mentioning about home ownership and how, the age of the homeowner is older. Part of me wonders if that's pent up homeowner demand. And I know it is a sign that now there is a strong renter base, and I'm not going to discount that. And especially because it has been trending higher. So we can probably expect continued high renter demand. But someone could also say, yeah, that means that there's a lot of people that want to buy homes. And once home prices go down, they're going to start being homeowners instead of renters, and they may move from the A class into a home. And that's where I would think that the effect would be specifically in the A class. But that's again like putting the cart before the horse, because those homeownership trends have been going for a long time.
Yeah, that's for sure. So this graph on the right, I think, is maybe even more interesting, and it shows the difference in asking rent between A properties and B, C properties broken out regionally. And Matt, for some reason, Moody's Analytics bucks the trend of calling it the Southeast and instead goes with the South Atlantic. Do you think they carved out the Deep South here and they're just not going to pay attention? Like those states that don't touch the Atlantic, Alabama, Mississippi, Louisiana.
I don't know. They're getting cute.
Where are they?
Cute.
Where are they putting Texas? Which one is Texas in?
It's like the companies that are spelling multifamily with a dash in there.
Yeah.
I thought and you know what? This is a digression, but my kids had the states, they know all the states. They had tests, geography tests.
States and capitals.
And it was actually very fun for me to do because you have to draw in all the states, and I left out, I think Maryland was one of the ones I left out. I felt kind of bad, but I got an A, arguably, if I grade myself. Missed a couple states, but 48 out of 58 bad.
Not bad.
But they split up their regions. I know the census regions.
Mm-hmm.
I was like, oh, regions, let me do it. I tried to trace the borders from memory, and the ones we're familiar with: Midwest, South, the West, and the Northeast.
Mm-hmm.
And they split out the Southeast and
all by itself,
Southwest, and I don't know. That's weak. Yeah, so that's what they're doing here. They're getting cute.
Yeah, I guess so. Well, I mean, I guess the bottom line is look at the green line on this graph.
Yeah.
Right smack dab in the middle and the Goldilocks zone as compared to other markets. So this graph shows that in the Midwest, that's the green line. The difference in asking rent between A and BC properties is about $700, which is slightly above the U.S. average, which is the royal blue line in there. If you look at where the spread between A class rents and B, C class rents is the smallest, you find it in the high supply areas of the Southwest, the purple line, and the teal line, the South Atlantic region. So
that Northeast is the one that stands out to me, though.
Big time stands out. And I think, there has to have been very little high-end supply built recently.
That's
there.
Makes sense, yeah.
And, it gives this opportunity for pricing power in the A space because it is way up there.
Yeah.
Right.
And maybe that's why starts are the highest in the Northeast. There was some data on that last week that we covered.
Yeah.
Northeast starts higher than other regions. And like you were talking about, you build it and they will come. And I've always thought, like, when it comes to being a developer, that's got to be such a fraught position. Because what if you build it and they don't come? You're counting on people to fill up. You can't just have a magic. They're not just going to magically call people up. You got to do a lot of legwork.
Yeah.
I think the legwork that you're doing is looking at the stats like this, where, okay, how much of a premium do really nice apartments get? And again, you're also probably looking at the jobs coming in, et cetera, et cetera. Mm-hmm. But like, yeah, that is a difficult job to have. It's a lot more risky to me, and I'm sure that's priced in with the investment returns for development projects. But man, it's so much more risky to say, hey, here's an empty apartment, and now we have to figure out where people are going to spend $10,000 to live in there every year or more.
More, yeah.
And so that's crazy, and it's just like hats off to them, and they're probably really. They know what they're doing, but it's stuff like this where I wonder what all these factors are and how they decide to build where they build.
Yeah, I mean that's a great point. All this data that we ingest and process and distill, I think really continues to affirm our strategy, which is buying in the Midwest, solid B property in low supply markets. It's not flashy, it's not fancy, but it's risk adjusted and focuses on cash flow, right? And housing for those who need it. I'm encouraged by all this data, and I'm really excited about where we are.
Yeah, I agree too. I think that the thesis that you have kind of outlined to me and that the way that I understand how we operate is something that is a great antidote for so much of the volatility elsewhere in the market. It's a, smack dab in the middle.
Yeah.
It's like Midwest, Class B, stability. It's really, it's really hard to argue with that. There's a certain like conceptual purity to it. It's the most multifamily of multifamily. If I had to
That's right.
to talk about it.
That's right.
But yes, these news, and we're living in interesting times. It is exciting. It does seem like every single week there's so much valuable news and data on the housing and apartment markets. Great data comes out every single week. Things keep moving and changing, and we're going to keep moving and changing and tracking it here on the Multifamily Dispatch podcast and on the Multifamily Dispatch newsletter, which you can subscribe to at themultifamilydispatch.com. It's great.
What a time to be alive. What a time to be alive. I wish Bumpy the Hippo the very best.
Yes.
And thanks for tuning in for the latest episode of the Multifamily Dispatch. We will see you next week with some exciting news.